Morning, everybody. Good morning to you if you're listening in from the webcast as well. Last year, of course, was the first of these events that I did as your CFO. And 1 year on, I think I'm getting to know many of you a lot better. And I must say, before we get started, just how much I've appreciated the discussions that we've had over the course of the past year. So thanks for that. Now, as you can see from the agenda, which Andrew's just outlined, much of today's content is going to be set at a strategic level, particularly with the four categories and with Paul at the close of the day. But this afternoon, you get a chance to see something of our R&D capabilities and the home and personal care factory that you just saw in the video. And that, of course, is why we're holding this year's events here at our historical home in Port Sunlight. That is the Safe Harbour statement, which I will click through. And here's the agenda for my bit of the presentation. To set the scene, I'm going to talk about how we intend to unlock value in our business. First, I'm going to recap on where we are and set out the next phase of our development, what we are calling Connected for Growth. As I hope you will very clearly see, this is much, much more than just an organization change. I'm then going to move on and talk about how this will enable us to deliver accelerated financial returns. But I'd like to start with exactly the same chart that I finished with at last year's event in Singapore. This sets out on a single page our strategy for long-term value creation, and that's unchanged. On the left, you have the four compass pillars that are common across our whole business. Then we have the four differentiated category strategies, followed by the financial drivers of our returns to shareholders, and all of that underpinned by the Unilever Sustainable Living Plan, which is embedded throughout our strategy and which secures long-term value creation. Now, the most important feature of our 4G growth model is sustained investment in the business over time. Our brand and marketing investment is now some 2.4 billion euros higher every year than it was 7 years ago. This represents a cumulative increase of 10 billion euros over that period. At the same time, we've invested in our infrastructure, an additional 5 billion euros of capital expenditure compared to the rate we were spending at 7 years ago. As you'll see with Mark Engel this afternoon, this has created a supply chain that is more efficient and far better able to respond to the changing needs of customers and consumers with innovations that can be rolled out faster than before. We've also invested in IT platforms which give us improved functionality at lower cost. Over the same period, we've invested some 10 billion euros in acquisitions, bringing additional turnover of nearly 4 billion euros, mainly in higher growth personal care brands. We've disposed of about 3 billion euros of turnover, mainly in lower growth developed market foods businesses, realizing net proceeds after tax of almost 4 billion euros. We've also invested a total of just over 3 billion euros in increasing our share ownership in countries where we don't already own 100% of our subsidiaries. Most recently in Nigeria, taking our share up to 59% and buying out the minority shareholding in Egypt and the surrounding countries. Together with buying out the Leverhulme family rights in 2014, this makes a total net investment in M&A of almost 10 billion euros. So all in then, a total investment across all three areas of almost 25 billion euros. Importantly, the way we invest and allocate resources, be it brand and marketing investment, capital expenditure, or M&A, is now driven substantively by our category strategies. And as a result, the shape of our portfolio has changed. Personal care has increased from 28% in 2008 to 38% today, while foods is down from 35% to 24% and now much more focused on the attractive segments. With savoury and dressings growing in mid-single digits, this means that we're able to grow the entirety of the foods business at 2% despite the continued drag from spreads. As you know, spreads is a highly cash-generative business, and with the new BCS unit now in place for more than a year, we've been taking more cost out, driving the margin up further. It's now over 20%, while investing to improve consumer perceptions of the brands. We'll continue to focus on preserving the value of these strong cash flows and investing them for greater return in our business. Now, the investments we've made and the resulting changes in our portfolio and organization enable us to deliver a much more consistent performance. In the past, growth had been unpredictable and more often than not, lower than the market growth. Our growth is now consistently in a much tighter range, and in the last 6 years has been on average around a percentage point higher than in the previous 6 years. We've also grown consistently ahead of our markets, typically again by around 1 percentage point. This step up in competitiveness is well illustrated by the latest Kantar World Panel Report. Now, this was an analysis that covered 1 billion households across 44 countries in the world. They looked at 300 billion shopper decisions to see how many times a brand was chosen by consumers over the course of a year. And what they found was that Unilever's share of the top 50 global FMCG brands is 24%. That's well ahead of the next nearest competitor at only 14%. In fact, our portfolio includes 6 of the top 10 recruiter brands, which shows the number of new households reached each year. For example, Dove reached 31 million new households and Sunsilk 25 million new households. Our growth has also been consistently profitable, with core operating margin increasing by an average of 30 basis points every year. Now, strategy is important, but execution, day in and day out, is also absolutely key, particularly in our industry and particularly in a volatile and highly competitive environment. The broad average of growth in the previous chart masks hugely divergent market conditions around the world. In most of Europe, benign commodity costs have led to a period of sustained deflation, while in Latin America, costs have been rising dramatically as a result of devaluation, and market demand, measured in volume, has been contracting. In much of Asia, pricing has been subdued by historic standards and is now starting to pick up as commodities turn. In India, the government is making much-needed changes. We see these as positive for the longer term, as they will help create a more level playing field to compete on. But in the short term, they are likely to be very disruptive. And in countries like Russia or Turkey, conditions remain challenging and uncertain. I think it's worth a reminder that we're well placed to manage through these periods of volatility. We have a portfolio of brands spanning price points that allow us to capture downtrading as well as uptrading. Pricing is managed at a local level against strategic price positions set by the categories, but always with an eye on consumer affordability. Our model is one of consistent investment to protect and build brand equity to come out of these periods of volatility with ever stronger market shares. And we've taken the agility in our supply chain to change our sourcing arrangements quickly when needed. That was the case in Russia when they imposed overnight trade barriers with Ukraine, for example. You'll hear more about this from Mark this afternoon. Finally, as we manage through commodity and currency cycles, there's no change to our focus on competitiveness, which we measure through volume and value share. With these important changes under our belt, we are now well placed for the next phase of our transformation, which we call Connected for Growth. Making this change is hugely important. The environment around us quite simply demands it, and the speed of change continues to increase. New trends and technologies are shaping the future, disrupting traditional models on a global scale, while at the same time encouraging fragmentation at a granular local scale. We see changes in our consumer groups, media choices, competition, and route-to-market channels. You've heard us refer to this before as hyper-segmentation. These changes bring challenge, but also huge opportunity. We are well placed with global scale, but also deep roots in local cultures. Our portfolio spans price points that meet the needs of different income levels and includes a mix of both strong local brands and local jewels. But the changes do put an increasing premium on innovation and agility. Previous programs like Project Half and Marketing Fit to Win were the right thing to do at the time, and they took us very much in the right direction. But we're now addressing change more holistically. The first chart I showed today sets out the enduring what of our strategy for long-term value creation. This chart shows the how we will actually deliver this over the next few years. As you can see, it all comes under the umbrella of Connected for Growth, and it represents the biggest change Unilever has undergone in the last 10 years. There's a lot on the page, so let me take you through it block by block. At the heart of Connected for Growth is the organizational and core process change to make us faster, simpler, and more agile, putting more resource directly in our markets, more consumer and customer-centric, and ready for the connected world. We've invested a lot of time in the redesign, as it's really important to get this right, and we're now putting it into place. At the heart of the new organization is what we call CCBTs. These are country category business teams. As the name suggests, they're located in the countries, and there are about 250 of them. So for example, Personal Care UK or Home Care Brazil would be CCBTs. Now the CCBTs are responsible for driving performance, brand penetration, market share, and competitive growth. They're cross-functional, with the marketeers now part of a single marketing organization, all reporting to the categories and just one click away from the category president. At the same time, we're strengthening the global brand communities so that they are closer to the markets and can select exactly the right person to create a piece of work or lead a project as required. This way, the new organization will reduce duplication and handoffs, unlock trapped capacity, make us more agile and lower cost. More bang for the buck, fast pickup of local insights into actual projects, whether they become local or global innovations. And the new organization will help make us ready for the connected world. We've already trained more than 5,000 of our people in digital marketing so that they can apply the tools that we've deployed to connect with customers and consumers on their digital paths to purchase. We'll see a lot more experimentation in digital marketing, which is really in the spirit of a more agile and a more connected company. And all of this will ultimately help us to deliver innovation which is stronger, which is more on trend, and which is delivered faster. The most important driver of growth for the foreseeable future will be growing the core of our business. This is our number one priority. It starts with increasing penetration by concentrating on executing best on the most frequently purchased SKUs that represent most of our sales, the core of the core, as we call it. Then expanding the core in high-growth segments. You'll see many of these today. Male grooming with brands like Dove Men+Care, natural segments, Lipton tea capsules for machines, or Cif in the rapidly growing household care segment in the emerging markets. And finally, growing what we call supporters. These are the SKUs that are specific to particular channels and help us to unlock new shopping opportunities. Growing the core is the most important thing we need to do to deliver profitable growth in the next few years. But it's not enough to secure long-term value creation alone. So we will continue to evolve our portfolio. Our acquisitions are driven directly out of our category strategies, like the entry into prestige skincare, which is growing nicely and in line with our plans, like the expansion into male grooming with Dollar Shave Club, the entry into the fast-growing air purifier market with a bias to China, and the acquisition of a natural home care brand in 7th generation. And we're developing new channels, both organically and through acquisitions. In refreshment, we're finding new ways to build the equity of our brands through retail operations, including both our existing brands like Magnum and Ben & Jerry's, as well as acquired brands like T2 and Grom. Dollar Shave Club, as well as taking us more broadly into male grooming, gives experience of a very different direct-to-consumer subscription model and a high level of one-to-one engagement with the brand and its growing product range. And we are building our capability with e-retailers like Amazon, Ocado, and Tencent. I'd like to show you a short video now that illustrates this. It shows how our partnership with Alibaba is helping to unlock growth in rural China through Taobao Village. Can we show the video, please?
Alibaba and Unilever have started to work together in 2010. The partnership has grown really from strength to strength. We started off with trading, but the relationship today is so much more than that. What we're seeing right now here in China is really a hotbed for everything that's happening in the space of e-commerce and digital. The way the Chinese nowadays live their lives on their mobile phones, doing almost everything that you can imagine in the digital space is just amazing. Many people often look at what's happening in the US or in other places, but it's actually right here in China where the frontier and the pioneering is taking place. Big players like Alibaba and their partnerships with companies like ourselves are shaping the new innovations and the new business models, etc. If I just see what has happened over the last few years, and just imagine what's going to happen in the next couple of years, we're going to have a great future together here. Via big data, Alibaba and Unilever have been able to unlock opportunities that we didn't have before. The partnership between Alibaba and Unilever has been able to get us more than 1 million new users into our brand franchise, especially on the brand Clear, our shampoo brand. It is Alibaba's network which is able to give us the accuracy and the efficiency to engage and communicate with consumers in a way that was not possible before. During last year's Singles Day, Omo became the first FMCG brand to partner with Village Taobao, and we shipped Omo from the factory to town service centers in each of the villages, no matter how far they are from the large city centers. During that time, Omo successfully penetrated more than 2,000 villages in 23 provinces across China. Through the creation of Village Taobao and its network, Omo was able to reach consumers directly and efficiently. A brand has been built, consumers are happy, and of course, we've charted new ways of reaching deep rural China.
I found it very reassuring that somebody with a Dutch accent needs subtitles and not just people that grew up in Glasgow. That was a big highlight for me. Now, underpinning these changes are the programs that we have put in place to build our agility and our capabilities. We're now able to roll out key initiatives faster and more effectively than we ever have before. Net revenue management will have been rolled out to 50% of our turnover by the end of the year. Zero-based budgeting is now in the full implementation stage, and I'll give you an update on that in a moment. And we're staying at the leading edge of marketing with a global initiative that we call Digital 2.0 to deliver consumer-centric, data-driven, multi-channel media. The program brings together a number of initiatives under one umbrella to create a scalable model for brands to replicate with a mobile-first approach. So those are the building blocks of Connected for Growth. It's a new organization with new processes that will result in stronger, more on-trend innovation delivered faster. Growth will come through driving the core, evolving the portfolio, and developing new channels. And it will be enabled by 3 key programs: net revenue management, zero-based budgeting, and Digital 2.0. And all of that is going to result in a faster, a more agile, and so a stronger Unilever. Let me now turn to how we expect to translate all of this into accelerated financial returns. Let me start with zero-based budgeting. We're pursuing ZBB savings in 18 cost segments, 12 of which are led by designated senior business leaders and in 22 different cost locations. In recent presentations, which you can find on our website, we've shown some examples of how we benchmark against other companies. In this chart today, I've put just a few examples ranked by size of the actual savings we've identified and have now built into our plans. The dark blue bars are in marketing and the lighter bars are in overheads. In many emerging markets, we advertise well beyond the point of saturation. And across markets, we switch films too frequently, well before perfectly good assets are in fact worn out. Changes to media guidelines will allow us to reduce or redirect the spend without harming brand equity or our growth. We'll reduce the number and cost of consultants that we use in the business, making better use of in-house capability for project management and using a more professional procurement approach for those consultancy services that we do buy in. New policies for international assignments will bring down the cost of relocation and reduce the number of assignments. We'll focus these very much on developing our top talent by giving them valuable in-market experiences. We'll remove any in-store merchandising that isn't aligned to brand strategy, and we'll use technology to ensure better in-store assembly and reduce write-offs. Switching to digital promotional gifts like mobile airtime will reduce the cost of execution and massively eliminate waste. And finally, in travel, we're already quite close to the benchmark, as you might have gathered from last night's accommodation. The granular nature of ZBB allows us to identify savings in specific areas like how we book and use ground transportation and taxis. Since we already have a separate, well-established supply chain program that delivers more than €1 billion of savings each year, we've put the ZBB emphasis onto marketing and overheads. But we're now extending this out to apply the principles of ZBB into the supply chain, particularly in the area of logistics, and that's helping us to identify fresh savings there also. I'll stress again and again that ZBB is part of our 4G growth model. And this is fundamentally a reinvestment model with competitive growth and steady margin improvement sustained over the long term. ZBB gives us much greater cost visibility and accountability. It challenges us, and it brings us new and disruptive thinking. It allows us to unlock savings which we can then decide either to take to the bottom line or to reinvest behind growth. ZBB, it really is a key enabler of Connected for Growth, and Connected for Growth enables ZBB. It's been running in parallel to the organizational and process redesign. Now we come to the implementation phase, which we started a couple of months ago, and the two are implemented as one. Our aim is to have the organizational changes largely implemented by Q3 of next year. We're on track to realize the savings we had targeted of at least €1 billion from both programs by 2018. And with the extension of ZBB to areas of the supply chain and a further wave of smaller countries, we now expect to deliver more than €1 billion in savings by 2019. Having reinvested substantially in recent years to strengthen our brands and infrastructure, we can now retain more of the savings we generate while still investing sufficiently to maintain competitive growth. As we move more of our advertising spend from traditional to digital channels, I'm often asked which is the higher return on investment. But to be blunt, the answer is that that's the wrong question. The returns depend more on the quality of the advertising than the specific media channel. But it is true that the highest returns come from campaigns that effectively span all channels, with traditional and online content reinforcing each other on the many touch points in the new path to purchase in a digital world. So that's how we are increasingly developing our own campaigns. We're also producing advertising more efficiently. We've set up Unilever Studios, which are in-house creative studios that can respond to advertising briefs in a faster and more effective way. For example, if our marketing teams want to respond to live news, you shortcut having to pitch it out to an agency to produce the advertising content. In supply chain, the reduction in working capital and supply chain cost has enabled us to invest in modernizing our manufacturing. This was much needed after years of underinvestment to be safe, efficient, and support our innovation and our growth. And in IT, we're getting improved functionality at a lower cost. To drive business innovation, we've moved to a technology platform-based approach. Technology platforms are an integrated set of global shared technologies made up of reusable components that support our business capabilities. By shifting to platforms, we're streamlining our investments into fewer, more strategic technologies that we can scale more efficiently. In the new strategy, we're following three key principles: designing for digital and mobile first, leveraging cloud-based technology, and limiting custom-written code. All this means that over the next few years, we expect to accelerate the improvement in core operating margin. We will continue to improve the mix of our business with margin-accretive innovation and the focus on margin in the home care and ice cream category strategies. With the extension to logistics and the rollout to smaller countries, we expect savings from ZBB and the organizational changes to be greater than €1 billion by 2019. That's a higher rate of delivery than from earlier programs like Project Half. And we expect to be able to take more of our savings to margin, increasing our retention rate, while still investing sufficiently for competitive growth. Let me turn now to how we translate profit into cash. First of all, working capital. This is already negative 6.1%, so growth in itself is cash generative for us. But we see further opportunities of 1 to 2 days per year in our stock levels. Secondly, capital expenditure. After a period of stepped-up investment when CapEx ran at over 4%, we're currently in the range of 3.5 to 4%, and going forward, we will bring this down to a range of 3 to 3.5%. And finally, pensions. Annual cash costs have been running at around 700 million euros for the last few years, which is around 350 million euros higher than the P&L charge. We're undertaking a funding review of our pensions and considering alternatives, which could include asset guarantees or a one-time cash injection to reduce future cash requirements. So this is our new financial growth model for the next few years. In the current low market growth environment, in which market volumes are flat, we've been delivering underlying sales growth consistently in the range of 3 to 5 percentage points. Now, we cannot, of course, precisely predict future market growth, but we can plan for a continuation of current growth rates for the next few years, perhaps with a little bit more volume, but less pricing in Latin America. In recent years, we've increased core operating margin by around 20 to 40 basis points per year. Looking ahead to the next few years, we expect to accelerate this to between 40 to 80 basis points. This year and next are years of transition. Restructuring costs will be slightly higher than the normal 100 basis points or so. We therefore expect core operating margin improvement in 2016 and 2017 to be in the lower half of the new 40 to 80 basis points range. And we expect to increase our cash conversion rate going forwards from the current level of around 80% to 90% over the next few years. We had been guiding to a tax rate of between 26 and 27%. We now expect the rate to move towards the upper end of the range, so around 27%. And our financing costs will reflect an average interest rate on net debt of between 3 and 3.5%. These actions are part of a strong financial strategy. It all starts with the delivery of 4G growth, consistent, competitive, profitable, and responsible growth. This leads to increasing cash flows with higher margins and greater cash productivity, which in turn enables continued reinvestment in bolt-on acquisitions to evolve our portfolio and build capabilities. We'll target around 1 to 3 billion per year. Including the goodwill in these acquisitions, we expect to sustain our return on invested capital in the high teens. Growing a business with this level of ROIC is, of course, highly value-creating. And this supports our continued policy of sustainable, attractive, and growing dividends, whilst all the time maintaining the financial flexibility that comes from a robust balance sheet. And with that, before I hand over to Alan, maybe, Andrew, you could join me up here and we could take a few questions.
Yeah, first, maybe I could just correct something I said right at the outset. When I think I asked you to turn your mobile phones to airplane mode, I, of course, meant silent. We're not trying to isolate you from the outside world, as you can imagine. So let's take some questions, please. Who'd like to be first? Hi, Warren, I think. Yeah.
Hi, Graeme. It's Warren Ackerman at SocGen. How you doing? Just on that margin guidance, 2017 to 2019, can you flesh out a little bit more what the drivers of that will be by category and maybe by geography, when it had been home care, but margins have already moved up a fair bit? That'd be quite useful. Thank you.
I think the category strategies are unchanged, Warren, and we'll continue to drive forwards. We've made great progress with the home care margin, as you know. We set out with an original, just to drill into that for a second, we thought we would get close to double digits. We're now virtually there. As I've said before, I think the home care margin, we have the ability to keep driving the margin upwards, so the category strategies fundamentally underpin that. The second thing is our approach to innovation. You know, having 75% of our innovation being accretive to gross margin is a very, very large driver of that. And then just looking around the geographies, whilst we need to invest to remain competitive, first and foremost, a lot of the investments that we've made over the course of the last 3 or 4 years have been focused in North America. Our margin came down in North America as a consequence, and we're now seeing quite a fast recovery of the margin in North America as we get a return on that investment that we've made. So they would be the 2 or 3 things I would call out, Warren.
Yeah.
Morning, Graeme.
Hi, David.
Just to come back to your point about return on invested capital, return on the advertising and the switch of advertising. Should we assume that BMI spend a percentage of sales comes down as part of that margin improvement? Is that part of the logic in terms of that improvement? Thanks.
I think I wouldn't be as specific as that because, again, we will invest to remain competitive, and the mix of what sits in overheads versus what sits in BMI, you know, could move as we do things more in-house, for example, as we create Unilever Studios. You know, we move to more things being booked in different lines of the P&L, so it's difficult to be very precise. But I think what we should think about is that automatically increasing BMI as a percentage of sales being a good thing, and it perhaps slowing down or stopping to go up as a percentage of sales from time to time being bad is not necessarily the case. The mix of investment, and actually the mix of investment of what might sit, you know, above the revenue line, even in terms of investing, you know, with customers, all of that mix will change and be much more dynamic going forward as we see these shifts in channels and we see these shifts, particularly at a consumer level, in how they consume content.
Okay, David. James, yeah.
It's more a question of just how you monitor the margin. How quickly, Graeme, do you know how the margin's changing? There are so many moving parts in it. Are you able to track it like day by day, week by week, and make corrective actions where appropriate, or is it something that you only really get a grip on every month or two?
No, we have full visibility, of course, of all the components making up our margin at a point in time. But having said that, we don't micromanage it. We know that the actions that we set out to take during the course of a year are first of all the right places to be investing around our portfolio, because we're targeting growth and we're targeting competitiveness, and we need to be able to land the innovations that fundamentally support that in a healthy way. So yes, we watch it all the time. Yes, we understand what the component parts are that move it. At the end of the day, we are talking relatively small movements on a very large business at the end of the day. So there's an ability to always, you know, land the ship at a particular point, at a point in the year. One of the things I should say that I think helps us to manage the business in a proper way was when we stopped, disclosing and talking about margins on a quarterly basis, just doing that twice a year. And it sounds, sort of less guidance, etc. But actually, in reality, what that does is it really allows you to manage the business in a much longer term and more healthy way during the course of a year. So we have good visibility, but we don't micromanage. We don't have to.
Jeremy.
Just a sort of best guess, what are you projecting for growth of your markets over the next sort of 2 to 3 years and your rate of outperformance?
Okay, so let me talk about the outperformance. It's very, very difficult to, go out there and take a position on market growth at the moment. I mean, Andrew and I might privately have have £10 on it, but it's very tough to get. We think our markets are growing 2 to 3% at the moment in aggregate, and towards probably the lower end of that range. But part of the reason it's tough is because getting a relevant read on markets becomes harder and harder as more and more business shifts to unmeasured channels, etc. And that's why what we tend to do in assessing competitiveness, the most, I think, robust measure is what's your measure of category growth? How are you doing in the category relative to the category growth over the long term? And if there's a delta there and you're ahead, then you're competitive and you're winning share. But over the piece, we've also thought about the business as well, is well over 50% of our business winning share. That's another way of looking at it. And then you can get down to the sort of basis point levels where we're typically gaining, in aggregate, 20 to 30 basis points of share in aggregate each year. But of course, aggregate share is not a very great thing to look at. It doesn't really tell you very much. What I think will continue really is, how are we doing and who is really winning in the marketplace? And actually, in aggregate right now, we're gaining, say, 30 basis points of share across the piece. But the big winner really is local players. Local players are up about, in terms of what we look at, about 90 basis points. So that's 120 basis points between us and the local players. Not that we're not a local player, of course, in each of the markets that we operate in. Where does that come from? As far as we can tell, the other global companies, the other multinational companies, have given up some share within that, down about 50 basis points, I think, and the other are 70 basis points, and about 50 basis points, I think, has come from private label. That would be the broad mix, and everything we're doing with Connected for Growth, more global, more local, is to make us more competitive in those markets, to make sure that we continue to win share in markets in that sense, and compete well against ever stronger local competition.
Robin,
hi.
Yes, thank you. Just a question about the portfolio. You seem to indicate that spreads would be retained. There wasn't any particular statement about that. Just confirm that. And obviously, you're talking about M&A being 1 to 3 billion per annum. So that implicitly rules out any big strategic acquisitions. Is that the conclusion?
Probably not, no. What I wanted to emphasize by making the point that the very valuable cash flow that we generate in the spreads business is reinvested in the business was simply to highlight our very high return on invested capital. That is the best place to deploy the cash flow that we get from that business. I didn't intend to send any signal regarding optionality for the business. As I've said before, we won't speculate, but we continue to review very widely all the options for the business, which I think everybody knows and appreciates. When you get down to the 1 to 3 of bolt-ons, and the reason for the wide range, of course, is that it's a bit like London buses. Nothing much happens for a while, and then suddenly you'll do 3 or 4 things that'll take you up a little bit in terms of spend. But I think that has been a very, very successful strategy for us so far. As I didn't give you the turnover numbers specifically, but we've done about, acquired businesses have brought about 4 billion of top line into the business at a multiple of about 2.3 times, thereabouts. We've sold businesses with turnover of about 3 million, so net there's been about a 1 billion increase from the strategy, and we've sold at about 1.9 times turnover, so we sold pretty well as well. And I think that's worked. It's worked to reshape the portfolio that way. Of course, the bigger way to do that is with a more strategic transaction, and our approach to that hasn't changed. That we need to retain the flexibility and the ability to look at more strategic transactions, but it's not something that we think about day by day, which we do more often for the portfolio of ongoing portfolio of bolt-on acquisitions.
I think we'll take one more question before we hand over to Alan. Hi, Celine.
Hi, Celine.
Oh, so can you wait for the mic? Sorry. Yeah.
Sorry. On the question on top line, you alluded that you had a period of 4% on average, 5% then in the past 5 years. Just to come back to your answer, you said the market is up 2 to 3%. You want to outperform that. Are we concluding that 2 to 3% is less growth than it was in the past 5 years, and therefore this 5% average is going to be, I don't know, 3 to 4? Is that?
That's pretty much exactly right. The level of market growth has come down. We'll continue to outperform the market by a similar margin. But it's dropped down, and therefore we've moved our financial growth model, growth rate expectation down to between 3 and 5%. Currently, we're sort of momentum rate of about 4%. We're pretty much in the midpoint of that range, but we could see it could oscillate within a 3 to 5% band rather than a 4 to 6% band that we were at before, which is about market growth rates overall, not about our level of competitiveness.
Okay, great. Thanks,
Okay.
Graeme. So we'll hand over to Alan.
Thanks, everyone.
There will be more Q&A at the end of the day with Paul, of course.